Today I'm going to be reviewing the second ever property that I purchased outside my province. This is a 6-unit building located in St. John, New Brunswick, purchased in December 2018 for $115,000, and now today worth $339,000. So this is a commercial building and it's valued based on its income, not based on a comparable analysis. So if you own a house that is 4 units or less, most likely a single family, it is valued based on an apples to apples comparison of other houses within a certain proximity that were built within a certain year, certain square footage, bedroom mix, style, renovation, finishes, all that stuff. What appraisers do is they look for other houses that have sold similar to yours, and they want to see how close yours matches up with theirs, and based on those previous sale prices of those comparable houses that they found, that's what determines the value of your house. So the average house, the average home, up to 4 units, so it could be duplex, triplex, or fourplex, any houses in that range are valued based on other comparable sales. When you get into buildings that are 5 units and above, and you can make the argument sometimes for triplexes and fourplexes, you can value it based on an income approach, but typically when it comes to 5 units and up, this is a 6-unit, or commercial or industrial or any other type of real estate that is income generating, it is valued based on the income that it generates. So it's based on its net operating income. And what happens is you take your top line income, your bottom line expenses, you subtract your expenses from your income, and that gives you your net operating income, your NOI, and you divide that by the going cap rate in the area or the market in which you're investing. So this property, we were able to take the net operating income from $9,000 up to roughly $24,000 when we were finished, and that is really the value add, and that's how we were able to gain roughly $189,000 in equity. So I'm going to walk you through it. I'm going to bring you up on my iPad here so you can see exactly what it is that I'm looking at, and we are going to dive into it. So this is the property here, Cedar Street, nice 6-unit. You can see over on the left hand side that we have a purchase price for $115,000 and initial cash invested of $52,000. So out of that $52,000, that includes the down payment on the $115,000 house of an 80% loan to value mortgage, so we're only putting 20% of that $115,000 in. It also includes a buying cost, which it has the appraisal, environmental, home inspection, loan origination fee, corporate setup fees, legal fees, title insurance, all that sort of stuff. And then it has our improvement budget, which allowed us to increase the rents to create the equity that was generated in this building. So I'm going to take you down to the bottom, and we're going to go through the various types of improvements that we did. So you can see on the right hand side is the total cost, and on the left hand side is the units that had those improvements done to it. So in this building we really didn't do much in terms of improvements. There was nothing done to the mechanical, there was nothing done to the structural, there was no exterior cosmetic improvements, there was nothing done except for just remodeling the interior units. And if you look on the right hand side, you can see the cost of those units, the cost that was spent to remodel those units so that we could advertise and charge and demand a higher rent. A lot of times when I'm underwriting deals, I would budget $5,000 to $7,000 for a total cosmetic renovation of a typical apartment unit. So within the 2 to 3 bedroom range, 1 to 3 bedroom range. And what I see looking at this, what this tells me, and these are actual costs. I will bring up the renovation quote here, and you can see the different types of units and the costs and what went into those units. So what I've done in the past and what I do and what we do, we ask our property managers to take our contractors in there, and they'll provide us a quote prior to purchase so that we can get a rough idea what it's going to cost to get these units turned over and to get them improved so that we can achieve the type of rents that we are analyzing and that we believe we can achieve. So this is the quote, and I'm going to come back to the improvement page. And as you can see, a lot of these improvements really were not that much. Most of them, $2,700, $2,800, $1,800, $3,600. Those are all quite low, and what that tells me is that this building is actually in relatively good shape because there wasn't really that much that was needed to be put in to improve it. It's just cosmetics. Unit 1 was definitely a bit rougher. You could see the 8700 on there. And a lot of it was just removing junk. It was redoing floor. It was repainting. It was repainting countertops. We were repainting cabinets. We managed to salvage a lot of the kitchens instead of having to rip all the kitchens out and spend a whole bunch of extra money. We were able to just repaint them, put a brand new countertop on there, cheap ones from IKEA, brand new fixtures, light fixtures, hardware, that sort of thing. You really don't have to spend that much to be able to create significant value in property, and that's where a lot of people go wrong. They start putting in granite countertops. They'll rip the whole entire kitchen out. They put all brand new cupboards and brand new drawers, and they spend way more than they need to. You just have to know who it is, who your clientele are, and who you're marketing to. So this property is in a middle income area, so the tenants who are renting from us are not expecting to have granite countertops, and you're not going to be able to achieve a rent that would make up for that cost to give you a return on paying for that granite countertop. So if I come up to the rents as purchased, on the right hand side is the rents that when we bought the building, that's what they were being rented out for. A lot of these rents didn't even have leases. The owner was a self-manager, which is a good opportunity that tells you that it's a good opportunity to purchase the building, because typically when people self-manage, I don't care how good they are, they're not going to do a better job than professional managers. Every property that I have is managed by a professional managed company. They've been doing it for decades. They have tens of thousands of units. They're going to do a far better job than me, and they're going to do a far better job than you. So whenever you hear or find a property that is being self-managed, you know right away that there's an opportunity, or there might be an opportunity to go in and to buy a property that is significantly underutilized. So with this current owner, there was hardly any leases in place. He was leasing to some of his friends. They weren't paying on time. They trashed the unit. There was a couple hoarders in there. We had piles amount of garbage that we had to clean out of these units. A lot of the units were missing light bulbs. Some of the taps weren't working, and the property owner just didn't care to fix these things. And when it came down to it, he was also afraid of vacancy, and he was afraid of having these high turnover and vacancy costs, so he never increased the rent. He wasn't able to realize this building's full potential because of the fear of losing his tenants and having to potentially put more money into it. So him keeping his rents low and not advertising for better tenants did not allow for his building to maximize its full value, and that's where we saw the opportunity to come in and purchase this building. So I'm going to go to the stabilized rents, and this is what we're currently renting it out for. As you can see, the top one, Unit 1, the 2-bedroom, which was previously rented out for $700 a month, we're just getting shy of $1,000. Most of the other units were able to increase roughly from $100 to $250 a month, and that's where we saw a significant amount of the value. We weren't really able to reduce much expenses. We did renegotiate a garbage contract, which ended up saving us about $900 annually, and we were able to get some other minor savings on the expenses, but there was nothing significant. This building was just a cosmetic renovation to bring the rents up to the market rate. That's typically all we did here. So from purchase, the gross rent that came in was $33.50 over here on the right hand side of a $40,000 annual rent roll. When you come back to where it is currently today, it is now $4,620 a month to $55,000 annually. So about a $15,000 bump in gross rent revenue for the building, which gives us a value. It's actually gone up since this point in time, but it gives us a value of roughly $329,000 and a cash back of $156,000. So basically, our strategy is we like to get our money back within a 2 to 3 year time window. So what that means is that within 2 to 3 years, we want to be able to improve a building enough that we're able to refinance out all of our initial investment. So with this property, you can see how it has initial cash back. This is on the stabilized version. So on the purchase version, it had about a $54,000 purchase. That was our total investment. Where on this one, 2 years later, it has a cash back instead of initial investment of 124,000, which means we got our 54,000 back that we initially invested, plus we got an additional $124,000 back from the refinance. So we, in theory, we were paid $124,000 to purchase this property, which we still hold on to and we still manage. That generates us $24,000 a year in net operating income, roughly $7,000, $7,500 a month in cash flow. Sorry, $7,500 a year in cash flow. Out of that, there's about $17,000 in debt payments, where roughly just maybe 40% of that is principal, so we are still generating some revenue there. So typically within that 2-year period, we want to get all of our money back, which we did, which makes it an excellent BRRRR method. And we're able to recycle it and purchase more property and roll it into some more. So when we first purchased this property, the property had an appraised value of $115,000, which was based on a cap rate that the appraiser used of 9.34. So that's taking the existing net operating income and dividing it by 9.34. 9.34 is relatively high. However, the area is a little bit rougher, so there is some variance allocated to that cap rate to be so high due to the risk in the area. But at the time, the market was in that range, typically an 8% cap range. Since we've bought it, and within the last 2 years, we've been able to see a significant cap rate compression. So this is due to us buying in a market that had strong fundamentals and waiting until the rest of the country and the rest of the investors were able to understand and see that these fundamentals were good enough for them to start placing money and buying there as well. During that time, our last appraisal that came in, we had a cap rate, I believe, of 7.5. So we saw roughly a 1.84 compression in cap rates, which if you were to do that on the multiple basis, a 9.34 is a multiple of 10.7, which means for every dollar you earn in net operating income, you times that by 10.7, and that's the value of the building. But as that cap rate compresses and it becomes a lower dollar or lower nominal figure, the value of the building then increases. So with it now coming down to a 7.5, that gives us a multiple of 13.33. So every dollar net operating income is now times by 13.33. So you take our 24,000 and change net operating income, you times that by 13.33, and that arrives around our $339,000 figure is what the building is currently worth today, which gave us a 2.63 multiple difference since we purchased it in just 2 years ago. So with that 24,000 that we have in net operating income, you times that by the 2.63 multiple from the compression that we were able to achieve. That gave us an extra 65,000 in building value. So we, of course, were not preparing for that. That is just icing on the cake. But out of that $214,000 lift in property value, the $189,000 in equity that we were able to generate, 64,000 of that was just from buying in a market that had strong fundamentals and us being able to realize on those fundamentals once the rest of the market caught up and came in alliance of where it was. So that you can't plan for, but when that happens, it's very fun and exciting. And I know a lot of investors in provinces such as Ontario and BC, in big markets, large metropolitan markets like Vancouver, Toronto, Hamilton, Victoria, they've been able to experience this significant type of appreciation and cap rate compression over the last year. So us out in the East Coast finally got to have some fun. But I truly believe it's mainly due to the fact that everyone is so hungry for yield and cap rates are so low and returns are so low in other markets that investors finally started to look outside their own backyard, and that's when they came across markets such as St. John or Moncton or Fredericton or anything else on the East Coast or in the prairies inside of central Canada. They began realizing that, hey, I can easily invest not in my own backyard. I can invest elsewhere and participate in these great returns that everyone else is participating in. So the market is beginning to reflect that new influx of money, which was able to allow the cap rates to compress and come down from a 9.34 to a 7.5. And this was also in a period of COVID, and we had massive government stimulus. We had the Fed easing policies, monetary policy, and we had a low interest rate environment. So I believe all that together is what allowed us to participate and realize a significant appreciation in this market. So with that being said, having that additional 65,000, even though that is great, we did not plan on that. We bought this property initially with the intention to at least be able to generate roughly $220,000 to $240,000 in forced lift. We believe we could get it up to that number. We believe that on purchase we were able to get this property up to about a value of $220,000 to $250,000 without having any change to the current economic environment. So without that $65,000 lift, that icing on top, we still knew that going into this deal that we were able to get our money out within a 3-year time frame. We knew that we could add value. We knew that there was issues that we could solve, and we knew that on purchase it was a cash flow building. So whether we did anything at all, if we did nothing, we knew day one we were making a 9.34 whatever percent return on the purchase price. So we know that day one we were cash flowing. And that's how we buy all of our assets. We want to make sure that at least within month one, we're producing income. And then within the next 3 years, we're able to add enough value that we can pull out the money that we initially invested and to have a quote unquote zero down deal and infinite return so that we can take our initial investment that we put in and roll it into more property. So I will show you some of the photos of what this building looked like before. And you can see a lot of it is just dirt, messy tenants, just poorly managed, and nothing too crazy. And then I will pull up the after photos, and like I said before, we really didn't do that much. Fresh coats of paint, some flooring, we redid some of the appliances, and it turned out to be a nice little property. And it really is quite simple, guys. It is just, all we're doing is we're finding mismanaged, undervalued assets that we know that we can improve the minute we take these things over. So all we do is we look for properties that are under the existing market rent, and we use websites such as Rentometer, MapLive. You can do comparable searches on Kijiji and Craigslist, but our best resource for understanding and to know where our market rents are going to be is speaking with the local property managers that we use. It's speaking with the appraisers that we use, and it's combining the combination of our own research on third-party websites such as Rentometer and MapLive and Craigslist, Kijiji, Facebook Marketplace. It's combining that with our property managers and our appraisers' opinion to arrive at an average of where we think that the rents will be. So we ask them, what do you believe a nice fixed up 1-bedroom would be? What would a 2-bedroom be, a bachelor, etc.? We put all these lists on one side, and then we take what the building is currently rented as on the other side. And just that right there alone, we can tell that we're able to add X amount of value, or if there's a deal at play. The other thing that you can do is significantly decrease the expenses. So if you can increase the income, but you can decrease the expenses, your net operating income still increases. The money that comes into your pocket at the end of the month, if you can reduce your expenses, is still greater without even having to touch the rent. So with this building, we didn't have that much of an opportunity. It was still a pretty tightly run ship on the side of the expense things. But we were able to reduce our garbage contract, which means outside the building there is a large dumpster that every bi-weekly a third-party company comes, picks the dumpster up, removes it, takes the garbage out, puts a new one back down, or simply just changes out the garbage and leaves the dumpster there. So through me simply sending an email saying, hey, I believe that our rates are not adequate or they're not up to market, I'd like to renegotiate this, maybe put it on a longer time frame instead of having it as just a month to month deal. Hey, let's stretch it out over a 4-year time frame, but since we're providing you that business, we would like to have a reduced monthly ongoing cost. We were able to save $900 annually off our expenses from renegotiating that garbage contract. So if you take that $900 and you divide it by the cap rates, because you're saving that $900 and you divide it by the going cap rate of 7.5, that's $12,000 in building value from us just sending one email. So I sent one email and our building value went up by $12,000, which then we can go to the bank and refinance out the percentage of that based on the loan to value and then we can go use that and buy more property with, or you can put a down payment on a Tesla, whatever floats your boat. But that's simply what it is. So a lot of times we'll even buy property just because we see that there's significant expense overhead and we know that doesn't need to be there, or we know that we can get it for cheaper, and we'll be able to arbitrage that and buy the property and simply reduce the expenses and be able to create value in that sense as well. That's pretty much it, guys. That is really our strategy, and that's this property. Thank you very much for listening to me and following along. Hopefully you're able to get some good value. Don't forget to like and subscribe. I'm going to try and do more of these videos as I get some more free time. But as it stands right now, I'm very tied up with other things. So unfortunately, I haven't been able to put out as much as I wanted to. But going forward, I'm going to try and focus and put any spare time I have into creating more videos and to be able to provide good and valuable content for you guys, and to be able to get you closer to that financial independence number, or whatever it is you're trying to do. You're trying to grow a fund and make millions of dollars and live on a beach in Fiji, or if you're simply just trying to quit your day job and spend more time with your family and things that you love and your hobbies. So hopefully we can all get you there, and we can all get there too. So thank you very much for staying tuned, and I'll see you in the next video.